The bull market is on. Jerome Powell came out today and delivered rate cuts and signaled that more may be coming ahead, but it's not guaranteed. There are some caveats that you need to know as an investor to stay calm, confident, and on the right side of market risk. In this video, we're going to break down what those caveats are, what you need to know to be prepared for the next 3 to 6 months, and why you should be very excited about what's coming next. If that sounds good, like and subscribe down below, and let's hop in to today's video. So the Fed cut by 25 basis points today because of the weakness in the labor market that we've been signaling on this channel for the past 2 weeks. If you've been with us, you would have been prepared for this. You would have understood that the Fed was getting ready to cut rates because the labor market was showing weakness. A lot of it started with this chart here, showing almost 1 million jobs revised downward from the non-farm payrolls earlier this month. That was a major red flag that the labor market needs help. They need a little bit of stimulus. They need a little something. And so when Powell comes in and cuts rates, that is stimulative for the economy, and it's good for our bags. It's good for risk assets. It's good for altcoins. It's good for crypto because it encourages more borrowing and it encourages more risk-on behavior. More liquidity, more risk, higher prices. So listen to what Jerome has to say about the balance of risks. So the balance of risks here. They're balancing inflation and the labor market. Right now, they've been worried about inflation a little bit more, but with this revision and with subsequent jobless claims, they're worried about labor market a little more. So listen to what he has to say about the balance of risks here.
The risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
So he's moving in the direction of neutral. He's talking about the neutral rate, the rate at which monetary policy interest rates are no longer too tight or too loose. That's about 3.75. After today's cut, we're sitting at around 4.25. So we have about 50 to 75 points down to go before we get to below neutral rate. So we got a little bit of ways to go. Now, the labor market did drive the decision today. It really didn't have anything to do with inflation. Jerome had this to say on the topic. So again, the labor market was the focus of today's decision. This is important for us to understand, and we'll talk about that later on in this video, why it is so important for us to understand why the Fed's cutting rates. They're cutting rates because of labor market weakness. So that is what we have to keep our eye on if we want to be prepared, calm, and collected about what the Fed's going to be doing, because the Fed and what they do is going to play a big role in how this bull run shakes out, how crypto performs, and really how altcoins do. Now, on the other side of the mandate, they still have to worry about inflation just a little bit. They're worried about tariffs. They're still worried about tariffs. The effects have been muted, not as bad as they thought, but it's still a concern. And again, that's important for us to understand, because if we know to keep an eye on inflation and the eye on the labor market, what we're looking for on each, we can say to ourselves, what is the likelihood here and how should I prepare as an investor? So listen to what Jay has to say on the inflation situation, about 20 seconds here.
It's really the risks that we're seeing to the labor market that were the focus of today's decision.
So they want to move again in the direction of neutral because inflation isn't as bad. So it's because of the labor market being weak and because of inflation not looking so bad that they can start to move rates down. As we move forward, and we will keep you up to date with this channel, what is inflation doing? What is the labor market doing? That is going to be important for us to understand what the Fed might do down the road. Now, that's what happened today and why. Next, I want to talk about what's going to happen next time and why. It's going to be data dependent. Markets were looking today really on the forward guidance that Powell was giving. The markets had already priced in 25 basis points. And so if we just go over to CoinMarketCap real quick, you can see that we're not going too crazy. We're having a nice little pump right now, but off the news of the tariffs, let's have a look at Bitcoin, kind of flat. Let's have a look at Ethereum, kind of flat. So it really wasn't anything crazy that we got in response to this. That's because, again, the market's priced in 25. They were waiting to see what Powell was going to say, what's going to happen down the road. Should we expect more cuts? Are we super bullish? Are we super hawkish? Powell's tone was cautiously dovish. And so really, he really didn't want to go one way or the other because, again, he's worried about inflation. He's worried about the labor market. They're in a tough spot. And so he's not going to lean too hard one way. He didn't really give markets much to work with. Market's priced in 25, we got 25, and not much else. If you're wondering why the market didn't go crazy, why the market maybe didn't sell off, it wasn't a sell the news event, whatever. That is why, because we got what we got, and we didn't really get much else. That being said, future rate cuts are going to be data dependent. We did get the summary of economic projections today. So have a look at this crazy thing. What the heck is going on? Don't worry about this. Focus on this. This is our projections for 2025. This is how many FOMC market participants foresee how many cuts. This is no cuts. This is one cut, and this is 3 cuts. And so we have 6 FOMC participants forecasting no more cuts for the rest of the year. We have 2 forecasting 1 cut for the rest of the year, and we have 9 forecasting 2 cuts for the end of the year. I like that. Boo to this person, whoever's forecasting like a rate hike from here. So on the off chance that you looked at that dot plot and said, I'm about to close this video, I got a nice little table here for you. Expected cuts for the rest of the year: 0 cuts, 6 participants; 1 cut, 2 participants; 2 cuts, 9 participants. So 9 of the FOMC participants think there's going to be 2 cuts by the end of the year. That's in October and December. That's another 50 basis points of cuts at least. This is going to be data dependent, but it's bullish that they're already projecting this, which means they probably think the labor market's going to continue to weaken. Remember what I've said on my past videos: where there's smoke, there's fire. And if you're looking at labor market data in front of your face right now, that's telling you there's weakness, significant weakness at that. Chances are there's more down the road. 25 basis points is a good start, but it's not going to get us where we need to be. That being said, I think the labor market continues to weaken, but ultimately it will be data dependent. And so I got Steve Leisman here. He's going to break this down. What does the Fed need to see to cut more rates? 30 seconds, have a look.
We're now in the position for the data to do a whole lot of talking here. If the economy weakens further, the Fed is probably well positioned here. The market is probably well priced. If it doesn't weaken further, then I don't know that I would be on the board who's saying we'll get another 50 basis points. As we remember, we're running 3.3% on GDP on the tracking for the Atlanta Fed. So I think there needs to be some considerable weakness to lock in that additional 50 basis points this year.
And so Steve telling us that he thinks the Fed needs to see more weakening in the labor market before we can cut rates again. I don't think that's true. I think we need to see the labor market grow. Where the labor market is now is what got us cuts in the first place. And so for the labor market to stay right where it is now, not going to cut it. We need to see growth. That being said, I don't think we're going to see growth in the labor market until we get more cuts. More cuts are bullish for us. This is why I'm here talking about this, not because just cuts for the sake of cuts. It's cuts for the sake of alt season. This is going to get us going. This is going to get us pumping again. So have a look here. This is the financial conditions over the ISM. If you've been with this channel, you know that where I'm going with this. And so what rate cuts do is they make financial conditions more loose. And so this is it going up. What follows it going up is the ISM. The ISM stands for the Institute for Supply Management. This is the business cycle indicator, and the business cycle is what we need to get alt season. And have a look at this chart here. This is the chart that shows us what we need to get alt season. This is the key. If you're wondering when alt season, when moon, when Lambo, this is the chart you want to look at. So we have the ISM. Again, this is last cycle. Look at last cycle. Look at what the ISM, this is the business cycle. This is the business cycle going higher. Look at what altcoins did as a result. The business cycle comes down and altcoins go down because the business cycle is the earnings cycle, okay? This is the wage cycle. This is how wealthy people feel. This is how good people feel about their finances, and subsequently, how risky are they willing to go with their investments. Right now, here, we're trudging along and people don't feel very good about their assets. People don't feel very good about their finances. People don't feel very good about their financial conditions. And so they're not going to go into riskier assets. They're just not. That being said, rate cuts makes for financial conditions to be looser, and the ISM will follow that higher. It's going to allow for more money to come into the system. Remember that liquidity is a function of the business cycle. So as people feel wealthier, more liquidity comes into markets because people are doing more. There's more economic activity. And when you consider the fact that the majority of central banks around the world, 70% in brown here, are cutting rates, and you consider that in gray here, the majority of countries around the world are in an expansionary stage, or the business cycle. The business cycle is the expansion of the economy. The U.S. being the largest economy and kind of the driver of global cycles, the fact that the U.S. is now coming into play, this is very bullish. It means all this, that this 70% of central banks and economies expanding and getting more bullish is going to allow for assets to go a lot higher. And so look at this chart here. We've got investors' exposure to major risk asset markets. The US is flat, Eurozone is flat, Japan's feeling pretty risky, and China's getting there. China has a big role to play in this bull market, and that is a video in and of itself. So keep an eye out for that. I'm going to break down what role China has to play in this bull market and the insane amount of money printing that they're doing and why that's incredibly bullish for altcoins. But as I was saying, looking at this right here, US exposure risk asset markets, this is going to go higher as rate cuts come in, as liquidity comes in, as rate cuts encourage more risky investing behavior. This is going to go higher. Absolutely it is. And right now, markets are only responding really to liquidity and central bank operations. Look at this, these weekly global liquidity charts. We've got a half a year breakdown here every 6 months. Then we've got a monthly breakdown here. I love these charts. Shout out Mike Powell. But really, you're seeing that liquidity is going higher. This is what drives markets higher. This is what markets are responding to. They're not responding to this yet. They're only responding to liquidity. So once markets start responding to the real economy, once they respond to economic expansion and the business cycle, the earnings cycle, people having more money, being more bullish, investing more, throwing more money into alts, that's when things are going to get crazy. And this is what cuts do for us. This is the beginning of a rate cutting cycle. When the Fed starts to cut rates, 100% of the time, markets return about 15% over the next 12 months. You heard me. 15% on average increase in markets over the following 12 months when a Fed starts doing a rate cutting cycle. That's why I think 26 is going to be bullish. I think the rest of this year is going to be bullish, and I think you should remain bullish as well. This channel is all about making you bullish and giving you the conviction you need, helping you zoom out, take your eye off the short-term movements of markets. Doesn't matter what happened today as a result of the pressure, as a result of rate cuts, because the end result is much, much higher. Liquidity is coming. Business cycle is going to expand. More rate cuts are coming. And there's a lot of other really bullish catalysts that I want to talk to you about, but I don't have time to do it in this video because most of you probably haven't even made it this far. That being said, and so thanks for being here. If you want to stay up to date with the catalysts that are keeping me extremely bullish, if you want to share in my conviction and be able to sit comfortably through the volatility of crypto markets, like and subscribe down below. Leave a comment. Let us know if you've learned anything. Thank you for being here, and we'll see you in the next one.